the history of investment starts from the moment when we as human beings were able to plan upfront enough. Meaning that when the agricultural revolution appeared, we were able to spend the whole year at one single place and then to produce some food that surpasses our own needs. And then we started to think how we can actually use those surpluses and invest them in order to get some profit and then invest that profit in something else, etc. The very beginning starts with that phase when we were able to plan upfront. And then if we look at the ancient Greece, in ancient Greece, we saw the first examples of something that looks like banks today. But what is specifically interesting to us are actually the modern ways of investment which appeared after the World War II. So VCs, as we know them today, appeared after World War II, and they were changing their shape throughout time. But in order to understand things, in order to understand the VC's perspective, we need to map who are the key people behind that. So first of all, I made up this Alice, who is a successful businesswoman, and she wants to invest her personal own money into something. If she has a conservative approach, and especially if she lives here in Balkans region, she would usually start with real estate, and many would end up there. So real estate is definitely the number one selection, at least for someone who lives here in this region. But if she wants to diversify her approach, then she would go with gold, ETFs, bonds, blue chip stocks. If she's a bit more open-minded, then in that case, she could go with stocks, crypto, or even sitting here up front, being some part of some panel and be an angel investor and decide to invest her money in businesses like ours are. But one day she receives a call from Bob. Bob is a managing partner at the VC, and obviously Bob needs to stand out of all these options that Alice has and needs to position himself as the best option for her to invest her money in. How he does that? So he's a managing partner at the VC and he has a great idea and he has a usual plan. He approaches her and he says, okay, Alice, you will be one of my 20 LPs in my VC. Default lifespan of a VC is 10 years. I have a strong investment thesis. I will go to these conferences. I will invest in Web3 startups in the early stage. I know what is my specific niche. And my plan is to invest for 3 years, then to follow up with those startups for the remaining 3 years, and then in the last 4 years to look for ways how to exit those startups. My plan is to give you 5x of your money. So basically, it's not something that gold can promise you. It's not something that real estate can promise you. Maybe it's something that crypto can promise you, but it's a bit more risky. So here is a safe plan how I plan to diversify. And I have a very strong network, so I talk with 50 startups every week. All these things are very important for you as a startup founder. Let's now put ourselves in the shoes of Eve, who is a startup founder with a brilliant startup idea. So, what are her goals? She obviously wants to move fast, hire right people, launch product to the market, keep her runway, gain some traction, and then later on scale. So those are all familiar default goals that we all want as a startup founders. We have some options on the table. One of the options is to bootstrap. Another one is to look for a specific grants that will support us on that journey. And of course, the third option is to go with a fundraising approach. And there are obviously some risks. Run out of money, we cannot ship, or we cannot ship on time, we cannot sell what we made, and we can make a wrong deal that can hurt us later. And obviously, Eve also has to stand out of all these options that we have on the table, that Bob has on the table, and out of all of these startups that he talks to every week. So she needs to come to the position to talk to Bob, and then out of those 50 startups every week that he talks to be his choice to move forward with the talks. So how the reality checks looks like after she talked with Bob. Basically, if you take a look at the stats, 65% of the portfolio companies of VCs will fail. And these are like the pure statistics. So basically, how they earn money from these bottom companies, which are like just 0.5%. And you need to keep these stats on your mind when you talk with VCs, because there are a bunch of reasons why they won't progress with talking with you. It doesn't mean that something is wrong with you. Maybe you're not part of their niche. Maybe you're not part of their investment thesis. But maybe they just don't see the potential for being here in the bottom group of, or better to say the top group of startups. And if they don't see the potential for you to be at least 10x, they won't move forward with the talks. And we might say it's cruel, but basically it's how the math on their side works. So what is the thought process? First thing that will come to their mind is what's your track record. Obviously, if you had some exits before, if you proved that you can deliver, and if you proved that you can skyrocket, then can you raise again in 18 months? Because usually what you seek for the specific round is time boxed to 18 months, and they expect from you to go to the next stage in 18 months and to have like a higher valuation, which already means that you brought at least some fictional growth to their books. Then, can you go 100x with my investment in less than 10 years? Again, if you remember Bob's model, he has a lifespan of a VC for 10 years, which means that the worst case scenario for him is not that you fail. The worst case scenario is that you become a zombie company that he cannot do anything with. So basically, he will push you forward either to fail or to scale. Being like at the status quo is not a good option for him because he doesn't have what to do with you. Who else is investing? Who else is already part on your cap table? And if you remember the risk for Eve, that she made the wrong deal. If she made the wrong deal in the early phases, and if she has a messed up cap table, it means that someone at the later phase won't talk with her because as simple as that, don't want to go in the mess. And the last but not least question is, are you ready for that investment and for that round? So all the numbers that you can showcase, are they fit with the model on the VC side? In case you're not ready, there are other options that you can look for. And obviously there are grants, incubators, accelerators, but what are the things that you need to take care about as a startup founder if you are on that side? First thing that you need to ask yourself is, what do I get? Will it enable me to move faster? Will it expand my network? Will it give me some funds, or at least provide me access to some specific funds in the later phases? So why do I enter this program? The second big important question is, what do I give in return? Obviously, each of these programs will ask for your time and will ask for specific deliverables, but beside that, are you giving some percentage of your equity, and how that will look like again at your cap table in the future when you want to approach some VCs in the later phase once when you're ready for that? And how that will affect the cap table in the later phase. Last year, we organized the very first Web3 incubator. It was actually the very first Web3 private equity incubator here in the region, and it was a very nice experiment for us. We entered this space and we tried to see what are the good role models and how we can replicate those models here in the region. So I wanted to take you from this perspective of investors through some key points from that experiment. So first of all, we got really great feedback for the program itself. Many people who were involved, including like the mentors who saw tens or hundreds of similar programs, said that it was the best program and best organized from that point of view or incubator that they've seen. Obviously, it has something to do not just because we are super smart, but also because we were investing our own money. So we were not following blindly some program that we took externally. We were actually trying to adjust it for specific needs, for specific markets, and for specific niches. And then obviously it has to do something that when you invest your own money, you approach it in a different way because you have zero provided budget externally. Another thing that became clear over this program, that lectures are super cool, but program domain-specific help is super needed. Why? Because that domain-specific help can move you much faster as a founder. So when you have a specific problem, you approach your mentor, and that mentor is here to help you with the problem solving. Not going too general, but just focus on the specific problem and unblock you, enable you to move faster. Third thing that became obvious is that if we continue to do it as we did it, like locally or even regionally as Balkan, it's very hard to have a continuous supply of ideas and founders. So we are not that big market, and we cannot play with the same strategy as someone who is, for example, sitting in China or India or even, I don't know, Romania, which is like a bigger market, etc. So we need to think about something else, how we can actually expand and have a continuous pipeline. There is also a need for funding, because although you might be early as a startup for VC fundraising, you still need some funds in order to launch to the market and in order to come to the stage for a pre-seed or seed investment. We have to adjust the investment model. We'll come to that later, but basically the point was, okay, whatever we agree with you in this early stage needs to enable you to move faster and to come to the next stage without actually locking you and without having unpleasant talks with VCs that once when you come to a VC, that person says to you, okay, but I won't invest because you gave too big percentage to those guys from Ethic 42 Incubator or whatever the name it is. And many people asked us, since this was really great from a product standpoint, do you think to go even wider and to be like a general, not Web3 incubator? My answer was usually no. I think that we should narrow down our focus, not expand it. So it means that we shouldn't be like the general Web3 incubator, but we would even need to go into specific industries. So I walked you through some conclusions from the last year, but now how the thought process looked like in the background after all of that. Because I spoke with a bunch of people and I started to think, okay, how we can actually move this forward as a collective approach and as a community, because I don't have the interest to move this as a single entity or some consortium of entities. So first of all, if you want to have a continuous pipeline of ideas, and if you want to have quality ideas and enough founders to apply for your program, you need to have a global program. That's obvious. You cannot focus, at least not here in the Balkans region, you cannot focus locally. So that was the first thing that we were thinking about. If you want to provide a global program, then you need to be competitive in terms of the funding opportunities as well, and you need to be positioned as one who is provide funding on one side, but on the other side who has a super strong network of people. Then you need to focus with that super strong network and super strong mentors. You need to focus on the problem solving, because problem solving will enable founders to move faster, as I said. Then you need to create this inclusive and collaborative model that VCs can easily plug in and that is very familiar with their numbers and their models. Because at the end of the day, if you remember the beginning of this story, you have a chain of people who have their own interests and who have their own opportunities on the table. And again, you need to stand out as a super important opportunity for their deal flow. So from the point of someone who is an LP and who is investing in VC, then from a point of VC who needs to decide in which startups to fund and how they will get to their deal flow, you need to position yourself and to stand out as someone who is a good place for them to go and that they want to be part of. And of course, in order to do that, you need to have a simple and fair math. Fair is a very hard word because fair for you and anyone here in the room might mean different things. But you need to have like transparent math that will help you and to have skin in the game for everyone that you need. So at the end, this is what we came for. You have startups here, and basically startups who come to the program can have access to different pools of funding, investment pool or bounties pool. Why are those pools different? Because bounties pool is equity free. So basically you can look at the bounties pool as something which is a grant model for specific ecosystem partners. So you have someone from the industry who wants to grow his ecosystem, and then they say, okay, we will put money in this bounties pool and we will nominate specific bounties program, and all startups that fulfill criteria that we set and that build on our stack will be able to apply for this bounties pool. On the other side, you have investors who are putting money in the investment pool, and they have pretty much math that they're familiar with. So you have a program fee, and program fee is taken from bounties pool, investment pool. And you as a startup, you have a clear model. When I enter, I have a program that have mentors in the background, and those mentors can help me to move faster and to solve specific problems. So it's focused not just on the lectures, but also on the problem solving. Then I have access to 2 funding pools that I can choose from, and investment pool is obviously going through the safe model. Bounties pool is equity free. Investors are also delegating the steering committee, and you have obviously the incubator team, which is dealing with all of this and which needs to make it happen. So basically, everyone in this model is incentivized through a carry formula, and you have a pretty clear way how investors are getting their money back. So why DAOs are important? Because some of these specific problems and pain points that we saw from last year, and also when I started digging down and talking with people what was wrong with the previous model and what was wrong with the thought process, etc., some of these things can naturally be solved through decentralization and also through this collaborative environment. First of all, I said fair game is not, meaning fair is not same for everyone here, and each and every one of us can have different opinion about what is fair. But at the end of the day, at the end of the game, if we have a transparent model, that at least means that we know what is the math behind, and that we all agreed about that model, and that we can all contribute to improving of that model. Second important thing is liquidity. So native Web3 organizations can move much faster because they have access to funds, and they can fund their operations, and they can fund their startups much faster and get rid of the bureaucracy. So basically that's like one of the very important things here, that if you compare to the traditional VC space, you can move much faster here. Obviously you have all shared incentives and shared ownership, so everyone has a skin in the game, and everyone knows how can fit in this model, and even one person can play multiple roles. So I can be an ecosystem partner, I can be a mentor, and I can be also investor as an angel investor. So you can decide which role you want to play, or even multiple roles. Then through that approach, you have a community and investors network building, which is very important, because you don't want to be the smartest person in the room. You actually want to gather people that you can learn from and that you can share information with. So basically that's very important, that you can naturally as a DAO create those partnerships and stand out as a specific choice for some niche. And obviously the governance, that you can actually influence the model when you think it's not fair, when you think it's not moving in the right direction, when you think that you need some change in the strategy. You can actually propose something and actually vote for it with the community. So when you look at these pain points that we mentioned, and when you look at all these stakeholders, I think this future can help us, to move much faster, also to bring some funding opportunities to the region where we were not exposed to. Because like if we lived in Silicon Valley, and if we were going there to do events and pitches, maybe all this story would be much familiar to us, and we wouldn't need to think about how things look like on the other side. It would feel much more natural. But here, obviously, we are far away from that. And thanks to these kind of gatherings, and thanks to these kind of events and conferences, we can actually discuss how to bring all these opportunities to our startups in the region, and how actually to create also investment opportunities on the other side that we were not exposed to previously. So that would be it from my side. I don't know if we have time for questions.
I'm going to start the questions because startups are always shy, super shy. So
thank you.
This sounds like a very interesting model, but sounds like very hard to execute. But my understanding is you started before with the venture studio, and then you pivoted away into this. right?
Yeah.
Can you give us a little bit of like this was not invented from scratch, right?
Yeah, it had like several steps in between. So first of all, we had several exits as a group of people, and at some point after those exits, you decide and say, okay, how will I invest those money? And then we said, okay, we don't want to be like in the long run only the servicing business. We want obviously to have our own product, and venture builder model is a good fit for our own products. So we try to incentivize our people in the ecosystem, and for the first 2 years, it was only focused on the entrepreneurship side. So we had founder in residence program and people from the ecosystem that wanted to take the founder's role and to start their startups with our help and with our funds. Then at some point we decided, okay, it's a confusion because externally you don't know what MVP Workshop is anymore. Is it a venture builder? Is it R&D studio? How it relates to previous exits? Does it exist still after Celsius fiasco, etc., etc.? So basically you needed separated brand, but also you understood that you cannot move forward these things alone, and that you need like a wider group of people in order to make like venture builder successful. Then we started Ethic42 a year ago as a separated brand and as a new umbrella company on top of all other companies that we have. And as Ethic42, we decided, okay, let's see what are the natural programs that we can support founders through. And then incubator was one of the programs. We had the ideation phase, then incubation phase, then acceleration phase, and then the growth phase, tailored for the specific needs depending on which stage startup is. And then we said, okay, if we want to go externally and to attract new people to the program, then incubator would be the best fit. So that was the evolution.
I mean, it says it's an incubator. Do you do investments? It says like you do a safe. So like, what's the terms you give to the founders? Is there like a fixed amount for a fixed equity, or it's...
No, basically you want to do, ideally you want to go with a safe MFN, most favorable, because you don't want to lock them in the future. Because if you set a too low cap, then basically again, if someone is coming in the later phases, they just won't be able to join.
I actually like that a lot, that you said, like, if you take too much equity, right, then nobody's
so
gonna
invest. It's not the point, you know, that you take too much equity, because if you end up with having too much equity of zero, it's against zero. So the idea is to help them to move to the later phases, but also you need to take into consideration that if you're entering super early, then your 65% of fail will be much higher. So you have a higher risk, but you don't want to be too aggressive, because if you're too aggressive, then you just, you know, they won't be able to move forward without you.
But like, what's the average ticket size people can expect to get? There is money involved or not, right?
Yeah. Last year it was focused on one side on the funding and then on sweat equity as well. This year we go with funding only. So basically the idea is to have the investors pool, as I described, you have the investors pool and you have the bounties pool. So someone as, let's say John, because he's familiar with people, would be a perfect persona, because John can, from Telos point of view, be ecosystem partner, can be angel investor as individual, and he can be also mentor. So you want more ecosystem partners to be part of this journey, and to say, okay, here are the problems and our investment thesis that we want to support, similar to the grants model, similar to the hackathons model, just it's not 48 hours or 72 hours. It's a longer journey, and you need to go from the incubation phase. And then you give investment, which is similar literally to VCs and terms.
Thank you.
Can I ask also, would you say that 2.5% of accelerator that wants from your equity, it's a lot for a ticket, or it's no money, just like business help?
Yeah, I wouldn't say it's a lot, but you know what's the problem? When I was speaking with some angel investors, and usually what they think, okay, if I enter 2 months after you as accelerator or incubator or whatever, and I need to pay like 200K for 2%, for example, what is exactly the value that you brought to them in those 2 months that equals 200K that I need to pay? So basically at the end, you come up with those concrete questions that you need to have answers for. So you as a founder need to think about what is the value that I will get and how will I actually explain to my future founders that that value brought me to this stage, no matter if it took like 2 months or 6 months or 2 weeks. But actually, it moved me, so it pushed me so further that it has the value that I'm giving equity. On the other side, you as the incubator, investor, whoever, need to be aware that someone needs to come at a later phase and that you need to justify what is the value that you're bringing to the table.
And is it usually a problem for VCs if there is equity for incubator or accelerator, or that's normal?
Depends, and depends which incubator and accelerator. I assume that if you come from YC, no one would have that as a minus. Like everyone would perceive that as a positive sign. But again, if you come, from some other players, I know angel investors who just wouldn't invest. They wouldn't literally talk with you because they would like, okay, I know their model, I know that they're too aggressive, and if you already provided them with that equity, I just don't see how I fit into that model.